So good morning, everyone. Thank you for coming. I can identify many faces. A very good welcome to you, all to you. Today we are going to have a very interesting panel, but of course I'm not going to really anticipate anything that is going to be talked about. So here we have Nicholas Comfort, and please, I will give you the floor just, right away to you. Thank you, Nicholas, for coming.
My pleasure. So I'm Bloomberg's banking supervision reporter in Frankfurt. I cover the ECB and the SRB and other institutions day in, day out. To be completely honest with all of you, there are several 10-year anniversary events for the SSM this year. But to be completely candid, this is the best lineup that I have seen so far of any of these conferences. And I think that speaks, both to the dedication of the people on the panel for this topic, but also to Margarita Delgado's team here at the Bank of Spain for setting this up. So a big thank you to them. And it's not just the panel. Actually, I see quite a few banking celebrities, if I can use that word, in the audience today. So the coffee break should be pretty exciting as well afterwards. So we have a lot of time to dig into the topics today. Just so people can be prepared, sadly, there will not be a Q&A at the end of it. And I know to my journalist colleagues at the back especially, I know that's especially painful, but I can promise you I'll try to be as cheeky as possible in my questions to the panelists. But I'll keep it classy too. Instead of formal introductions, I thought during the course of the questions, I'll try to give you an idea, a bit of a background of the people, and maybe poke them in a certain direction that would be helpful. Because a lot of people here, you know them already. But so let's get into the details in just a moment. It's a round table, and so even if we don't actually have a table like King Arthur here in the middle, I think it'd be great if the panelists were to interject and to maybe even challenge one another during the course, and challenge me too maybe on my assumptions. So please feel free to jump in and make yourselves heard. My first cheeky question, if I may, goes to you, Jose Manuel. You were Secretary of State for the Spanish Economy Ministry up until 2011. And I wanted to ask you, Sean Berrigan from the European Commission said recently that back then, member states said something like the SSM wasn't needed, and even if it was, it would be impossible to pull it off. Was that the case? And if so, how did the change of mind sink in back then?
Yeah, Sean Berrigan said it must be the case. He's the Director General of the Commission. I cannot disagree with that, no. But more seriously, it was 2011, you said. 2011, it was the year in which the EBA was created. Not just the EBA, but the other ISAs as well. The EBA, ESMA, and EIOPA. And at the time, there was a discussion of the creation of these three entities, whether there should be coordinated supervision. The decision from the member states was clearly no. And that's why the EBA was created as a regulatory body, essentially, like EIOPA and ESMA. Now, this changed between 2011, obviously, and 2014, as we know now history. And now we have consolidated supervision only in banking, by the way, not on securities, not on insurance. And I'll come back to that if you give me time. But what happened between 2011 and 2013 was basically the euro area crisis. And I think the euro area crisis basically showed that it was difficult to maintain a monetary union without having financial stability in the banking sector. That financial stability in the banking sector initially was thought there was an issue that could be dealt by each country individually. Then there was this clear link between banks and sovereigns, or sovereigns and banks. It's not clear which way the causality went, but there was the link was there. And that link basically ended up resulting in that the credit spreads, if I might say, or the way in which monetary policy, if you're a macroeconomist, was being transmitted within the union was not homogeneous. There were different prices in different countries for money, and that was just not sustainable, and that gets transmitted to the banking sector. So that required banks to be more stabilized at that euro area level, and I think that's what led to it. On top of that, there was also the impression that it was not just an issue of large systemic international banks. There were events that if you have a domestic bank only operating domestically, it can have significant distortions in this context, in the loop, the sovereign bank loop, and as a result, the transmission of monetary policy, and that led in it was relatively fast, because by the summer of 2012, if I'm not mistaken, that's when the decision was basically taken to go. Which, by the way, if I might come back to the issue about the supervision, and I know later on you want to talk about going forward, but I don't want to get ahead of myself, but if I think about the debate right now on the capital markets union, it's a very similar debate in which there's this debate about there should be supranational supervision or not, with a reluctance by member states to go in that direction. So I'm not saying that history repeats itself, because I hope we're not going into a crisis before we get that part, but in that part, in that aspect of who wants to have supranational supervision, it tends to be obviously the European bodies that are more keen for that.
Okay, just a quick follow-up on that. I mean, because if we think no one wants to have another crisis like we had then, but if you look back to the people sitting around the table at the time, what did they need to, as you'd say in German, to jump over their own shadow? What do they need to find a compromise? And what could you then extract from that to capital markets union now, or even banking union?
I think the crucial point was well, as I said before, the connection between this loop of having national banks and the national supervision that in a what I would call almost mechanical way will lead to a potential link to a sovereign risk, and as a result of that affect the financing of the whole economy, not just a particular bank, but the whole economy, because the spread will go into the cost of financing for anybody that was basically financing itself in that particular country. And I think that led to the clear inconsistency between having a monetary union and not having supranational supervision of banks.
If you'll allow me, that sounds more like self-interest rather than the European spirit, but that's
Well, but that's, I'm an economist. I think self-interest is good, right? Yeah. I think that drives most of the decision-making of people.
Claudia Buch, I'd like to follow up with you, if I may. So you started as vice president of the Bundesbank in 2014, and you've had a special focus on financial stability throughout much of that time. But you also have something that many of us don't have, or either in the audience or on the panel, is that you had a number of international roles and international interactions. And so you know, I beg your pardon, how the world looks at Europe. And how did the world look at Europe as we built up the SSM? I mean, we saw banks build up more and better quality capital, but I'd love to hear sort of how the world perceived us.
Well, thanks a lot for the question. First of all, thanks a lot to you, Margarita, and the team for setting this up. I'm not sure if you can see this, but it's very impressive. If you look up, this whole building is impressive, the setup, the audience, and the panel, as you've said. So how does the world look at Europe in terms of what José Manuel just described, the institutional reforms we implement? And I would say that actually the context I had in the G7, the G20, they're quite impressed about what Europe did. So, I mean, we have to see that the reforms, the institutional reforms we implemented, the new rules, the tighter rules, the better rules, I would say, for banking regulation, bank capital, this was, of course, done in the spirit of a global agreement, a global consensus that a lot had to be done after the global financial crisis and the European sovereign debt crisis. So that was, I mean, if we think back, we just saw the news from Brazil where I think they didn't agree on a G20 communique. And so that was really in 2009, there was a strong commitment, agreement internationally that a lot had to be done. So this was the Basel reforms, where, by the way, maybe we can talk more about what lies ahead and what do we have to do now. I think we really have to implement the Basel III reforms. I mean, a lot has been discussed. Not everyone here in the room might agree on all the details, but I mean, it's clearly, I think it also puts European banking sector at a comparative advantage vis-à-vis others if we now implement what has been agreed. So there was a strong agreement that we need better regulation, we need better bank capital. There was a strong agreement that we also need to focus more on systemic risk, because that was clearly what we saw in the global financial crisis, that if a systemic crisis hits There's relatively little the microprudential supervisor can do. There's relatively little the individual bank can do, but really the system is at risk. The performance of the system for the real economy is at risk. So that was also a strong consensus. Better regulation, more focus on financial stability, and also institutional reforms in terms of resolution reform. So we have Dominique Laborex here, so his institution, the Single Resolution Board, and the whole framework around it. So what do we do with failing banks that we can't, most of the banks we can't, in particular the medium-sized, the bigger banks, we can't just send them to insolvency. So we need rules of how to deal with it. We didn't have all of this before the financial crisis. So coming back to your question on Europe, we implemented all this. So we made major institutional reforms. So we gave up power to the European level because we understood that if we just do supervision at the national level, we just don't see cross-border risk sufficiently. We don't have harmonized standards. We may apply different rules. We may overlook important issues related to cross-border activity. So we did that. We really gave power to the European level, and I'm not sure whether any other jurisdiction did some institutional reform to the same degree. We established the Single Resolution Mechanism, the Single Resolution Board. We have a better framework for macroprudential policies with the European Systemic Risk Board and also with the instruments that we're using and the procedures that we have to make sure that we all use the macroprudential tools in the same way. So, and this is really fully understood also by our international colleagues. So this is, I think, one strong message we get also from international meetings, that they really see the progress that has been made. And I would, again, I mean, economic historians might prove me wrong, but I would argue that actually Europe has drawn the most significant lessons from this from the crisis in that regard.
Okay, super. And then Margarita, if I may follow up with you. So you probably have the best understanding of the inner workings of the SSM of any of us here, thanks to the fact that you were there as a Deputy Director General of Microprudential One, if I remember, and then looking at the most complex banks, but then also seeing it from the perspective of a supervisory board member now. But it gets to the point which maybe some people criticize about the early days of the SSM especially, is that you had a lot of different colleagues coming from different competent authorities, and everyone had a way of doing things, and everyone wanted their way of doing things to be reflected. And so the optimist in me says, oh, well, then you get the best of all the worlds. But then the pessimist says, yeah, but you have a lot of people yelling at the same time. So how do you look back at those early days and think about whether the wealth of experiences and then the clamor of different voices, how you managed that balance?
Well, first of all, thank you to all of you for coming here. I think this is a super panel with, really top-notch panelists. Probably, I'm sure that this will be the best panel throughout this year, this 10th anniversary year of celebrations. But to your question, we've just listened to the background. This is what is the, let's say, the incentives to really, really snap your fingers and really go ahead with clear and pragmatic solutions, because this is something discussed at the highest levels. But of course, then people like many of you here, because they've been in the onset of the SSM and then of the SRB, they needed to keep working together, and that was the challenge. First of all, as José Manuel mentioned, the decision was taken in June 2012 by the European Council, of course, and then we needed to move together and start working, and that was really difficult. I had the opportunity and the honor to be part of some of the work streams, from the comprehensive assessment to, in connection to the EBA for the stress testing, also in the high-level group, which was the predecessor of the supervisory board, or the project team, which was a kind of a steerco, dealing with many topics. And there, we were already together I mean, all the national authorities, all the components of the future mechanism. And that was, for me, the very first, let's say, point in time where we really started to think about how to craft this out, because it was an idea, it was discussed in international fora, it was discussed at the highest levels, but I mean, you needed something to keep moving. So first of all, that point in time was before 2014. Indeed, it started in 2012, and then during the year of 2013, there were many things going on in parallel at the same time. We needed to decide which banks, which banks were under the new mechanism, and for the future of the SRB. I mean, I'm sure you remember, I mean, you both, you were there. So we needed to really define the banks, and the regulation, which was passed in autumn, in late 2012, in November, exactly, in November 2012. And then we needed the framework, a regulation, to really deal with the different components of the mechanism. So until then, we were starting, I mean, to work in a kind of a startup phase. We were clustering the banks into cluster 1, 2, 3, 4, and 5. I mean, I'm sure that most of you remember that. Under certain conditions, the conditions were just figured out and decided by the chair at that moment, together with the high-level group, together with the NCAs. But those were, I mean, in a way, in shaky grounds, if you allow me to say. That was the very first moment. The second moment, of course, was the recruitment phase. That was crucial. We needed to recruit 1,000 people in less than 12 months, which was really a challenge. It was a top-down structure. We started with the chair and the vice chair, and then the DGs and deputy DGs, and then the head of division and head of section, so on and so forth. But we needed, well, not 1,000, but nearly 1,000 people. So that was the second challenge, in the second moment. At the same time, we were discussing the methodology. Without methodology, we couldn't start doing supervision. So we had a kind of a small, tiny manual. We started with that, and then was expanded until, if I remember correctly, those days, those early days in 2014, the manual had only 700 pages. But some chapters were empty. Mm-hmm. So again, we needed to keep on moving. And there, the efforts were made, were enormous in terms of cooperation, in terms of coordination, in terms of understanding each other. I were with French colleagues, German colleagues, Italian colleagues, Spanish colleagues, Dutch, so Irish. So all of us had different concepts for doing supervision, for how to start with supervision. So we needed to really collaborate, dedicate a lot of time for coordination, and dedicate a lot of time to try to put in other shoes, because if not, was going to be a total failure. And finally, a lot of work was done, but also a lot of more work was needed to be done for the future. For the future, in that startup phase, mm-hmm. It was really, really hard. So, and again, the collaboration with the NCAs, without the collaboration of the NCAs, without the work and the efforts by the teams of experts in each country, this mechanism couldn't have been a success for sure. So many different, let's say, points or knots in the meantime, that, collectively, we had a major objective, and we were able to really overcome that. But it was really difficult, and I need to really thank people everywhere in all the countries, because without them, this could have been impossible, an impossible mission to achieve.
And just as a quick follow-up, Margarita, if I may, so was there something which you felt that the Spanish brought to the table, the Bank of Spain brought to the table that you were especially proud of? Danielle Nui used to always think about, oh, the Dutch are amazing with their fit and proper processes, and she used to, but was there something that the Spanish brought where you thought, that's how we left our print on the early days?
Well, at those times, at that time, Spanish people were really recognized for going very into the details. Precisely, we were specialized in credit file reviews, also in understanding the accounts, because we've been very, very powerful and strong for many, many years in accounting, and also for being very, very professional. That it's what I can, of course, speak for Spanish people. We brought to the table many things, but I will, remark all those two things.
Okay, well, credit file reviews are one of the most exciting for us journalists, I can say. Alessandra Perazzelli, so you have a background in the private sector, but you're now a deputy governor at the Bank of Italy and a colleague on the supervisory board of Margarita and Claudia. But so, looking from your role today, if you look back at what preceded you, under the first chair, under Danielle Nui, who I mentioned, NPL reduction was a big focus. And looking back, how did this serve the Italian banking sector and also the European banking sector as a whole? And maybe you could share some thoughts on how this built up also the credibility of the ECB banking supervision for rigor.
Well, first of all, I'm just so happy to start this celebration of these 10 years here in Banco de España. I enjoy very much, the beauty of the place and the friendship with Margarita Delgado and Claudia Buch. We are sitting there, and I think we're pretty much ready to start a new phase of the SSM. Well, first of all, I have to say, and I think, Claudia, you said it very clearly, that credit risk remains one of the main priorities for the 2024-2026 plan. So, we always have to keep that in mind. We are faced with a a macro situation that is going to put banks under strain, and I think that we can never sort of rest too much on these issues. But, if we go back, and at the time where all these rules and when, Margarita was mentioning the building up of the SSM, I was on the other side. So I was a banker, and I was dealing with these issues from a commercial and a strategic point of view. And if we look at the specific case of Italy, I think that this is a case that has created a benchmark very, very relevant for the rest of Europe. And it's really much a work that is strictly correlated between what the SSM put in place and what the Italian authorities were able to put on the ground and implement on the ground, dealing with, the specific banks that at the time were involved. If we look back, and if we look at, where some of the banks are today, I don't want to mention specific names, but, some of the banks back then were, in a very difficult position due to bad loans. Today, they're thriving on the market. And this is like the best success, the supervisors coming from different, cultures and different banking, sort of also industry realities can achieve. Now, if we go, I don't want to go too much into the technical, but if we go into the specifics of what was done in Italy, I think that there were three main issues that, were put in place. First of all, they were recognized, by the way, by the Financial Stability Board recently in the peer review. And first of all, we Banca d'Italia introduced in 2016 a dedicated reporting on bad loans. I mean, this was important because this pushed bank to more granular data, to go inside, to check, where these loans were. And they were providing the supervisors with the data that were useful then for us in dealing with the SSM, just to make sure that that geography was clearly identified. And therefore, we were able to go in and work on those specifics based on data that were never being available until then. So that was number one. I think that was the clever, move that Banca d'Italia made at the time. Then there was the Italian, authorities stepped in, and there was a change in the Italian regulatory environment. We had, 2 reforms of the judiciary that made it faster, to speed up the recovery procedures. Then we have all the dedicated tax incentives, for the sale of NPLs, and then we had also the GACS, the system that provided state guarantees for NPLs. And then that allowed then the development of a secondary market for NPLs. And that was also extremely important, allowed banks to really work on the market and make sure that the disposal of these bad loans was done in a good orderly way. Yeah. Now, all of this, of course, if we look at a specific example, that, the introduction of the Pillar 1 backstop and, the SSM supervisory expectations on calendar provisioning, all of this came together, you see. And all of this allowed Italian banks to really step up in dealing with NPLs. Now, I think this is, at the time, looking at from the other side, this was very, it wasn't an easy job for bankers, and it wasn't an easy job for most Italian banks, and also for non-Italian banks. But the one thing that I really appreciate about this, coming in at a secondary moment and looking at the work that has been done, this kind of thorough process, this kind of like real sort of looking at the banking sector in Europe for what it was at the time, is allowing us today, together with other measures that were put in place, to be so resilient. I mean, look, we're going through tough times, all right? And this work has really paved the way for European banks to stood up. We haven't seen this in other jurisdictions around the world. So we're very proud of that. I'm specifically very proud of what Italy has done. And I think it's a very good benchmark for others that maybe were a little bit more timid to go into this with both hands and work on it. So first success of the first chair, there have been good success of the second chair, and we are sure there's going to be great success of the third chair of the SSM.
Thanks very much. And I think sort of also for the third section of our conversation, for looking forward, the fact you mentioned the other authorities in Italy, which also stepped up to deal and to create the secondary market, shows as powerful as this SSM is, it can't do things alone. And they're...
But listen, it takes two to tango, and also in the banking sector. We are in the Euro system, and I think, Margarita knows this, we are on the same page of this. The dealing, the interaction between the national authorities and the SSM is the key. We work together. It's very, very important that the culture is a culture that is truly European. And I think that, in this specific case, it shows that it can be done, but it takes a lot of also generosity and courage to trust each other and to work together.
Indeed. So, and then over to you, Gonzalo Gortazar. You've been CEO of CaixaBank since 2014, which means he's on his third SSM chair now. I won't ask him which is his favorite, don't worry. But, but I would say one criticism of the first chair, my criticism and others, is that transparency was not her first priority, because she had other priorities. She had to set the place up. That has changed over time, and I was wondering how you have seen that evolution in transparency change. And I'd like to throw in a specific example, if I may. So you were one of the first movers on terms of European consolidation with in-market consolidation, in your case with the purchase of Bankia. How important was the communication from Andrea Enria and his colleague Edouard Fernandez-Bolo about this topic, also for you to feel confident enough in order to take such a big step?
Sure. Well, good morning. Thank you for having me here. Transparency has clearly improved. There's no question. When we really need to look back 10 years to see how things were then and how they have become, if not for the SSM. No? And then the judgment has to be unequivocally, in an unequivocal manner, to me, positive, and I would say very positive. The challenges that we had and the SSM had to create itself have been well explained by Margarita and other of the panel speakers here. So it was no small feat. And I think when you look back, clearly I see the glass half full. It's not full. I'll talk about the other things, but there's no question this has been a success, and it's been a European success, and it should raise our hopes of not just as to where we are, but as to where we can go. No? Back in 2012-13, we were all looking, and markets were looking at, well, the Spanish banks are doing this, but the Portuguese, the Italian, the Germans, the French, how can we compare this? And this is now, I wouldn't say 100% gone, but it's 90, 80% gone. And in fact, when we look at well, what's the SSM, what's the European Central Bank doing generally in the Eurozone, we may like it or dislike it depending on the case, but I think it's good to have one practice. There's no question. That transparency is being achieved in many manners. The SREP process is at least clearly explained in the way it goes. It's the same for all Eurozone banks. Obviously, then you look at the results, and sometimes you don't really manage to look at, well, this is my sort of governance and capital and liquidity position, and then my requirement of P2R is this, but I'm see some banks here and there, and how that works is not entirely transparent, in my view, and this is not necessarily going to be the view of all bank CEOs, but in my view it's probably necessary because there has to be some degree of judgment in the supervisor, and then rather than formulas. I particularly don't like formulas. Then sometimes we are applied formulas and we dislike it because we say, well, let's put some common sense. And some of this happens, but there is, I'm sure there's some room for improving the examination program, the priorities, the risks that the SSM sees that were communicated, and where the focus areas are going to be for the next year. All this is tremendously helpful. To us, it's also transparent to the market. So by all means, stress test, and this is obviously SSM, is the EBA. Again, these sometimes we get into the formula, and the formula sometimes works because bank models in Europe are very different, sometimes works in a different manner in terms of the results in different banks, countries. But it's a tremendous, I would say, step ahead in terms of transparency, no question. I think now the issue we have ahead of us is you look at this transparency, you look at the markets, and I love to talk about the markets not because I believe that the markets are always right, but it's an objective sort of way of a collective judgment at a single point in time. You look at the markets and they see the Eurozone banks, and they apply a very low multiple. So that's transparency because it's fairly consistent. There are some geographical difference. Some are doing slightly better, others are doing clearly worse, and there are some good reasons for that. All in all, 6 times earnings now. You look at the implied cost of capital from current valuations, and it's 16% for the Eurozone banks as a whole. You look at the cost of capital for the overall market, and it's 8%. 16% versus 8%, 6 times earnings versus 12 times earnings. Now, I believe banks would normally have a higher cost of equity, a higher cost of capital than the average sort of company because it's a different profile of, I would say, risk and reward. But it's never been so large. No? So that transparency is showing that something is not working there for equity holders. Then you look at the bond market, and you look at covered bonds, senior preferred, senior non-preferred, subordinated debt, additional tier 1, these are all working perfectly. In fact, when we finance ourselves in dollars, in the US market, in euros, etc., we find similar spreads. No? So the bond market, even up to additional tier 1, even though we had this big issue with Credit Suisse, and by the way, the SSM and the ECB reacted, I think, very well and very rapidly and say, this is Europe, we have different norms, this is not going to happen, so all hats off to that. I really mean it because we were all very concerned. But still it means that sort of all the fixed income market and related is working perfectly, very transparent, and equity market is not. Equity market shows there's something broken in the model, but not from the point of view of solvency, credit risk, because the fixed market is working well. No? So here we look at transparency. We've managed to get that transparency, generally for the better, but there are still some clear focus areas. And I'm not saying that is something that is easy to solve, this higher cost of equity. I'm saying this is now become, in my view, the most important problem of the banking sector in Europe, which, by the way, is not the case in the US. They don't have this high cost of equity. No? It's a puzzling. But beyond being puzzled about it, I think we need to do something about it, and that we may talk later. But to your second question on the transparency about treatment of mergers and capital, this was very helpful. Okay, basically, we had a clear rule that the P2R would be the weighted average of the two institutions. We would have preferred to keep our own P2R because it was better. And we were the larger institution, and the conversion was from the smaller institution to the larger, and we still think that should be the case. But in any case, you have a clear rule, you can measure it in advance. That's very good. We had a clear rule on badwill, which obviously badwill has certain consequences, and there was a bit of a question mark whether someone would understand this in a different way, and that was very useful. Restructuring charges, all these things that are sort of big items when you do a model and you're looking at a transaction. At the beginning, you have to take into account of all these things and then make sure that the value you create through cost savings. We had 1 billion cost savings per annum, and obviously that was actually we increased the target and we achieved it earlier than anticipated. That made it very compelling, the business case, and it was certainly helpful. On the other hand, I have to say that's the normal status of things. It would be very strange the banks do not how these things work in advance. So it was gaining some clarity on something that was, to me, much needed and relatively simple. I'm still puzzled, and this is not a fault of the supervisor here, but we hear voices as to further consolidation in Europe, generally. Tend to be more cross-border. By the way, we'll talk about Bankia. We actually were the first one moving cross-border with BPI in Portugal. We had great cooperation as well there from Portuguese government, the Bank of Portugal, and also the ECB at the time. So I have always gratitude there as well on that one. But now imagine you put two banks together. You do that share for share. So there's no capital flowing in, no capital flowing out. You just put them together. Accounting principles force you to reduce capital, okay? Because you need to mark-to-market the balance sheet of the smaller bank. Rates have gone up, so you're going to have that in 90% of the cases, fair value adjustments. So suddenly a transaction that makes a lot of sense because you're making two banks stronger by putting them together if there's a reasonable industrial project. The first thing you know is capital is gone. So you need to fund that, and that is obviously very costly. And to me, makes no sense. It's an accounting problem. The supervisor is just reflecting what the accounts say. The capital has not gone down, but your capital, pro forma, comes down in a share-for-share transaction. Then you need to fund restructuring costs and other things. So there is some, I think, wider rethinking. Are we doing the right thing? Showing that capital decreases when there's been no capital impact. And that's, I'm not saying that's my problem because we want to do something else now. We're very happy with our current geographical footprint. But when I look generally at consolidation, this is obviously also an issue domestically. I say, okay, there must be something that someone can be doing here to adjust for these kind of things, that now consolidation is more difficult because rates have gone up, no? And to be honest, banks are more profitable, safer, sounder, more attractive. So there should be even more reasons to look positively on capital of a combined institution. Accounting is forcing you to do otherwise. So.
So unless one of the supervisors would like to jump in and maybe defend the need for judgment in the SREP. The SREP, by the way, is the Supervisory Review and Evaluation Process for anyone who I'm sure you all know, but just for the consumer readers. Claudia, would you like to jump in with Margarita?
On the judgment part, but I think you just said this. I think we've gone a long way in terms of increasing transparency and standardizing the supervisory approach across Europe. And this is, of course, I mean, I'm always being asked, so what am I going to change? And clearly, I mean, nobody wants to backpedal on the transparency part. So I think we're basically building all the good work that has been done before. So that's very clear. And I think you said that. I think you also acknowledged that we need a judgmental part. So we can't just give, I mean, there's a lot of advancements with regard to artificial intelligence. And if you would go to the extreme in terms of, having no judgmental part, then we could just let supervision being done by a machine. We give the machine the number, and then, it calculates the P2R and the P2G. And of course, that can't be it. So I think we need, we need this consistent framework. We need transparency, but we also need supervisory judgment, because all the banks are different. I mean, we're not supervising, cloned banks, but very different business models, very different business models, different banks. So that's why we need the judgmental part. And I think I actually didn't hear you contradicting to that, so I don't have to defend that, because it's so clear that we need this space here.
Yeah. And,
maybe just a few words. I mean, on the transparency thing. I do agree that we've achieved a lot in terms of transparency. It was really needed. But of course, as I described at the very beginning of our conversation, I mean, this is a kind of an evolution type of thing, because we are starting in a kind of a more shadow, approach, and then we are starting to open up and increase transparency. But the transparency it's a very broad concept. You can have transparency with the markets, you can have transparency within the supervisory community, you can have transparency with the banks, or you can have transparency with, the media, right? So probably we need to really, apply the right recipe to the different dimensions of transparency. And this brings me to maybe one last remark, which is that for supervisors, sometimes, we cannot be that transparent as I will, maybe advocate or you will wish. Because, there are things that we are dealing with and are very sensitive. So transparent per se is not, in my view, the concept. It cannot be 100%. But of course, we need to keep improving transparency with, the public and with the banks, in order to make them understand why we are using expert judgment, or why we are using maybe some methodologies, or, to keep on, let's say, informing better about our decisions. And I think here we will need to keep improving and moving that direction. That is my opinion, but others might have other opinions.
Indeed. And José Manuel, did you want to chime in on that?
No, I just wanted to highlight exactly what Margarita just said, which is that there are two levels of transparency which are completely different. One is transparency in the relationship with the bank, and predictability and understanding of that, which in essence, that's a bilateral relationship which is private, should be private. And then the second one is transparency to the rest of the world, i.e. you, because the rest of the world essentially is you. Because, you are the, if I may say, the ventilator, or the loudspeaker. And that also needs to be improved, because that has a lot of benefits, and it has shown over the last 10 years. We at the EBA are big proponents of transparency towards stakeholders, but that should not be mixed with the same level of interaction, communication, predictability. There should be the bilateral conversation between the bank and the supervisor. That's a different level.
Yes, and I'd like to add to this, that we owe responsibility towards those entities that we supervise. in terms of our ability to deal with things in a also, conservative way. Not everything can be shared, and it shouldn't be shared. It belongs to us in a way that, we work on it, we study on it, we spend lots and lots of time with our teams. So I'm a big believer in the fact that, you do communicate and you do have to exercise transparency, but, with a grain of salt, of salt in it.
Alessandra, could I ask you to expand upon a point that Gonzalo was making, or to critique it? So the low valuations of European banks aren't just an issue for investors. It's also relevant for supervisors. If a bank needs to go out and raise capital, then it's good to do so from a position of strength. You come from a country where several big banks, I'm not naming any, have a price to book of close to 1, which, by the way, is a dream situation for when sitting in Germany. I think there are banks who are very jealous of that. Could you maybe share your views on how banks can regain the confidence of investors? Is it just a question of capital distributions, or is it something else?
Well, I think that right now we're about, we're standing at around 0.7 price to book value, so it's even a little less than 1. Listen, I mean, this is, it's kind of hard to look at it, because at the same time what you see is that these banks have been so good and, stepping up and be resilient, with what we have seen in the last while, and, the COVID, the war, and what happened in March 2023. I think at the time, Andrea Ria, was talking to us and talking to me one night and said, I can't sleep, because I don't know what's going to happen here, whether there's going to be, some spillover from what was happening in Silicon Valley Bank and then, over to Credit Suisse. And in the meantime, speaking about US banks, out of 6 regional banks have failed. Mm-hmm. We didn't hear about it, all right? But I mean, this has had to be said. Listen, I think that we are facing a number of issues here. The first one is, the sustainability of the business model as they are, the profitability of, European banks as we see in it. I think we have some, issues related to the market in itself, whether some of the activities that the banks are putting forward in distributing dividends and doing buybacks is the right thing to do. I think we can understand what they're doing. The issue, though, is whether that's going to be something that in the long run is going to work on making their value raise. The other thing that they are facing right now is this double revolution, of climate and technology. I mean, that is also something that needs a lot of preparation, a lot of change in the business models, a lot of change in the legacy that it's out there in terms of their IT ability to face all this. And there is also a big change in the competition, area, and they need to face that as well. I think that we are also dealing with maybe more Europe. Do we need to have more integrated rules on a number of issues? Do we need to move forward and complete the banking union? The role of banks also in the real economy, there still are the big lenders to most of our industry. How do we want to play, the capital union against all this? So these are all issues that are on the table right now. We have a lot to do in that regards. I think that from a regulatory point of view, we're moving in the right direction, and more, you've seen the stress test of 2023. I mean, that was a good results. Banks are, European banks are coming out in a very good place, looking at the future. I'm asking myself, I mean, this is a question, whether we need more consolidation. Europe is overbanked. Yes, it would be nice to have, European champions, but look at the way in which technology is playing around this. I mean, do we need to have M&A at this level, or should we talk more about what's happening with the interconnection through platforms, the entrance in the connections between banks and payment systems, asset management, fintech companies? You know, so I think that we need a sort of to kind of have a new look at the way in which we can push banks towards a better position when it comes to price-to-book ratio. That involves a lot of elements and a lot of new things that we haven't been looking at, you know, until now. So that's where we are. I think it's a great challenge. I think it's a great challenge for all of us. It's a great challenge for also the NCAs, you know, a national level. And I also am very much looking forward to the growth of new industry in the European system. So I was in Singapore, you know, when was that? Last autumn. And it was very interesting because we were talking a lot about innovation and, you know, how you push for innovation at the same time how you keep on working on financial stability. And there was a regulator from the UK that came up and said, you know, we look at Europe. The way in which, you know, the European, you know, legislators and the European supervisor has been dealing with a number of issues, we look at them because, you know, the putting together of this regulatory framework that concerns MiCA and DORA, you know, everything that we have been doing, it provides a soundboard for us, you know, issues that we are going to be facing right now. So I think that, I mean, I wish we all had a magic wand, don't we? Be fairs, you know, with a magic wand and fix it once and for all. It's going to take time. And it's going to take a lot of, I think, listening to the market, a lot of closeness to what comes out of the industry. And, you know, we are Europeans. We don't like co-regulation. But sometimes a little bit of that, I think it would be very useful.
Indeed. Unless anyone has a follow-up, I have a question for you, Claudia, if I may. So to shift gears a little bit here, in your early speeches in the new role, you've been mentioning the links between what's going on at the macro level and what's going on at the micro level. It's been a big focus. And speaking about scenario planning for unexpected risks, I'm not asking you to break out a crystal ball and tell us what the risks will be, but maybe you could give, especially the bankers in the room, an idea of how they should be thinking about these risks, and is it a question of sort of, and which parts of their business they should be thinking about, hey, does a climate shock not just affect my loan book, but also my trading book? I mean, are there perspectives you can give us?
Yeah. Let me maybe start quickly with a word on the valuations issue that has been mentioned, but I think it's actually linked to what you just what you've just said. So first of all, in terms of the facts a little bit, the valuations of European bank shares have gone up recently. I think this is also reflecting the higher profitability and the higher interest rate. So it remains to be seen, and it would be interesting to hear your views here on how sustainable that is. So is it just because, I mean, there's a lot of discussion on how long-lasting the effects of the higher interest rates will be, and that, of course, will also have an effect on the valuations. What is interesting, and I think this is also going a bit to your question, is that we do have to understand what's driving also the structural changes and the growth momentum in the real economy. So far we've been talking a lot about the banks and what's happening there, but I think we need to understand also what's happening in the real economy. An interesting fact is actually the valuation gap that we see for the banks. I think we also see it for other corporate sectors. So I think that's important to understand what is affecting the valuations in Europe more broadly. That may have to do with the capital markets union, but I think it also has to do with the structural change that lies ahead. So of course, I mean, there's always this argument, well, it's because of, you know, the valuation gap is there because of regulation and supervision, and we take this very seriously. We look at the facts, we do a lot of evaluation of our policies, and honestly, we don't see that any of this is related to the regulatory framework or to supervision, even more broadly. So there's been a lot of effort in the international community to evaluate the reforms that we've been talking about previously, and we don't see any negative side effects. I mean, we would be on our own be very much interested in seeing any negative or understanding if there are negative side effects so that we can alleviate them, but we're really seeing very positive effects of the reforms. So I think what we have to do, and that brings me to your question, is to really understand what can we do to maintain the resilience of the sector also in the future? And the big problem we have right now is that, first of all, we have a changed macro-financial environment with higher interest rates, a lot of other parameters that have been changing. We're seeing corporate insolvencies increasing in many of our countries, and speaking for Germany, I mean, and many other European countries, this is a relatively unique situation. So we had for like 20 years in Germany, there was a decline in corporate insolvency, very low loan loss provisioning, no credit defaults, and this is likely to change. So we have reflect all this in credit risk models like Margarita has been mentioning earlier. So this is the part which, I mean, this is classical credit risk, and I think we can find ways to deal with it, but the problem is that we have big geopolitical risks, so they don't easily lend themselves to be modeled in credit risk models. We have a lot of uncertainty as to how the international fragmentation of financial markets will play out. This is, by the way, also something that was discussed a lot in the G7. So we need to understand, I think we are at a period with accelerated structural change, also related to digitalization, as has been mentioned, and we collectively need to understand what it does to our economies, to our growth, and then also the banks who are basically reflecting also the growth momentum in the economy. And so this is where we need this very close interaction between macro analysis, so we need to understand what is driving structural change in our economies, and this is not just GDP forecasting, so the forecasters have a hard time in this new environment, but it's also related to structural changes, to structural change that we haven't seen in many countries for a long period of time. So our models, our formal models, our heuristics are not very good at understanding this. We need to understand how this affects the individual bank. So we've been talking about supervision is always about the individual bank. So how does it play out for the individual bank? How does it play out that we had serious shocks, and they were a challenge to all of us, but we also had strong fiscal support for the real economy. So that also helped the banks because the shocks didn't really affect banks' balance sheets. So, and this is where I think we need this very close interaction between macro analysis and what do we see on the ground with the individual bank, and we need to also understand how this can be factored into scenario analysis. So basically what I've been describing is uncertainty. And we know that if we have a high degree of uncertainty, we can't just, apply standard risk models. We have to work with scenarios. So we're doing this in the stress test scenario that we do together with Jose Manuel, the EBA stress test. But of course, this is a very specific scenario which may or may not fit to your individual business model. So you all internally also do adverse scenarios and try to find out what is really relevant for my bank, for my business model. Am I likely to be hit by a cyber attack? How do I respond? So, I mean, this is much broader than just a credit risk forecasting model. And this is, I think, where we are, where we're also working very closely with the industry, with the banks. We do cyber resilience stress test to also to first of all understand how would a shock hit the banks, and also to give guidance that with our results to the industry of how the forward-looking resilience can be ensured.
Super. And Margarita, did you want to follow up?
Yeah, very, very quickly, maybe, I mean, starting with Alessandra's remarks, I think, I mean, those are really relevant. I think the industry now is at a crossroads in a way, and most of them will have to decide what we want for the future. And probably this is, I mean, this strategy or lack of a strategy is probably what is impacting the most in the share prices in the stock market, because also this is clearly linked to the communication. If a bank has a clear line of communication strategy, probably together with, I mean, sustainable profits, we are not talking about a specific year profits, because I think there is no point for the markets just to measure the performance of a bank through 1 year. So this is more about sustainability of the business model, whatever the business model is or whatever the evolution is, and the communication to the market. I believe that this is something that really impacts on the price to book value. But of course, I mean, the banks are now in a kind of a juncture to decide what to do for the future, including, of course, digital, a payment system, or whether it is asset management, it is more the European champions. So I think the regulation is not an impediment. Of course, I mean, it is a kind of a burden, but it's something that is needed. And indeed, the reforms were really for the right reasons, because I mean they came to really solve situations that were really wrong and were impeding to growth in the European context. So this has increased the potential growth in Europe. So I mean there is no reason to really get rid of the regulation. We can maybe simplify some parts of it, but not by no means, I mean, getting rid of regulation. This is my point. So banks now need to decide what to do for the future. And probably this is something that is priced in the market, but I don't have figures to support my argument, but I'm sure that this is part of the story.
José Manuel, we've had two colleagues now mention the stress tests in positive terms. So I feel I have to balance this out a little bit about, with a negative perception as well. So, so Alessandro was mentioning that sort of this was a sign of strength for the European banks last year. But I would also point out that it was there was a bit of a rosy view among many banks during the stress test, and also maybe since the situation also changed since between you made the scenario and when it carried out, that maybe sort of the banks were a bit too active on being rosier there. So what do you think can the EBA do to move maybe more towards a top-down situation where the supervisors and the people at the EBA do more of the work, to put it bluntly, but also then have also maybe more confidence of the results?
Well, thanks for the question. This is before my previous intervention was about transparency, and transparency to who? And the stress test is the perfect example, because the stress test from the beginning was meant to be an exercise fundamentally on two aspects: on transparency, to try to generate confidence back to the global financial crisis, when there was really the perception there was a lack of confidence, because also there was a perception, a widely perception turned out to be true, of an underlying problem, which was there was not enough capital in the banks. So at the time, the transparency there helped to identify banks that will need capital, and there was all this discussion about who was going to put that capital, how the bank was going to get the capital, if no, is the country going to have a backstop to put that capital from the public sources, all that stuff. Fortunately, we passed that stage. Now capital levels are very high, they're about higher than ever, so it's not really anymore about identifying, who is the next bank to fail, or who is the next bank to lack capital. As a result of you, it's lost charisma for you. Mm-hmm. There's no more, like we say in Spanish, there's no morbo. There's not really any negative, news there about who is going to be the next. I remember in 2010, there were like headlines in the Financial Times with 6 Spanish flags, because there were 6 banks that needed capital according to the stress test. Now there's no even headline in the Financial Times when we publish the stress test. So, but that's good. That's not bad. Okay. Now, on the other hand, from the bank's point of view, when I think about it, for you, it's a betting machine. It's well, how can this help me bet on the future? And then when we fail, you blame it on us. You don't blame it on yourself that you're a gambler, but you blame it on us because we did not give you the right answer. For the banks, it's a beauty contest. Mm-hmm. It's not a beauty contest, so they just want to look good in the picture, and particularly better than their peers. And as a result of that, what we find in a significant way is that we go through this dynamic in which every time, and more or less, we publish the macro scenario that's been put forward by the ESRB, we get hit by the banks, and by the sector. This is a really, really dramatic negative scenario. You're going to kill the banks, you're going to kill the system. Then we go through the process, and the capital depletion is ever lower. And that's a little bit, the banks are better, that's for sure, but they're better also at gaming the process. And that's partially, in some ways, so like diluting the purpose of the exercise. So we need to work on that. What's the purpose of the exercise? The purpose of the exercise is to try to identify, in general, like it was back in 2011, if there's an agri-systemic vulnerability, that's our perspective, that's our point of view, that's our major concern. And if that is there, then we need to address it. And that's systemic. And the second one is to help the supervisory dialogue that we had before, in which each bank talks to their supervisor, goes through the process of running the stress test, and there are two outcomes. One is the one we publish, which is the quantitative impact and the transparency and the numbers. And there's another one that's the qualitative impact. How did they respond? Did they respond well? When they were asked questions, were they able to answer the questions? Were they able to provide information on a timely basis? And that goes in that private supervisory dialogue that they have, that I'm not aware of. But, I know they have it, but I'm not aware of the details. And goes into this rep process. That has to be constructive. Now, what we hear from the banks sometimes is that second aspect is becoming less and less constructive as well. So we need to work on that. So for the first part, you mentioned top-down. For the first part, the top-down exercise makes a lot of sense. You say, just want to identify systemic crisis, well, I go with a top-down scenario. Like right now, we're doing a top-down analysis, jointly with the other ISAs and with the ECB, on a climate stress test, which is on the Fit for 55 strategy of the European Union. But there, again, the problem is not about identifying individual weaknesses. It's about identifying that the system overall is capable of confronting that challenge. And by the system, I don't mean the banks. I mean the banks, the insurance companies, asset managers, the financial sector. For that type of analysis, the top-down makes a lot of sense. And we need to continue to improve that, while at the same time being able to provide a useful dialogue, which is constructive in the sense that it's a tool that's useful for them. I think the tool has become very useful for something that Claudia highlighted that's very important, which is we do one exercise, but I think the supervisors expect the banks to do many exercises, or different exercises, some of them more appropriate for their business model. So to build that capability, and to improve what we call the ICAPs, all that type of forward-looking scenarios, I think our stress test is helping build that dynamic. I'll give you just one example. In this last stress test, we included sectoral analysis, where we provided sectoral information, because the perception was that many banks had difficulties to identify how their credit portfolios will perform depending on the size of different sectoral shocks. Because in their models, a lot of what it is macro data. It's not sectoral specific data. And that's a way to push the banks in that dialogue and to hopefully help them understand that if you're a bank that specializes in a business model that provides lending to a particular sector, you may be more interested in having sectoral specific models than macro-based models. So that's one way in which we're progressing.
Okay. And indeed,
I hope I did a good job in selling this stress test.
By all means. Well, maybe the proof is in the pudding, and maybe the man who has to eat the pudding is Gonzalo.
By the way, congratulations. Since he's going to criticize me, let me be nice to him. We're celebrating his 10th-year anniversary as well. I just heard. It seems to me that it's harder to be 10 years as CEO than to be 10 years an institution, right?
I can imagine so. And sort of a lot of stress tests you've done over that period too. But well, first of all, Gonzalo, would you like to challenge me on my description of banks having rosy assumptions about the stress test? And if you don't want to, maybe you could also give us an idea of how, from the supervised bank, how the process can be improved in the stress test in the phase 1 and the phase 2, both in the terms of the quantitative and the qualitative evaluation of it.
Sure, thank you. I would say stress tests have actually fulfilled a very important mission, and have very successfully done so. And we just need to look back 10 years ago, and say, we've given that transparency and that sentiment that we are, as a system, fundamentally sound. And when there is a small or not so small problem, it's been dealt with accordingly. So I am clearly very positive on the ultimate picture. Now, obviously, life is about evolution. Once you go through one phase, you want to look at the next phase and do it even better. So and obviously, we spend all the time, generally in the private sector and in financial institutions, looking at what we do wrong to improve it. No? And when we don't see what we do wrong, these friends of us here today come and tell us and help us incentivize and do that. So that's perfectly fine to see stress having better function and the role, and still looking at how we can do better. The problem is, as Jose Manuel rightly said, one thing is how you give transparency to everybody, and there you need to somehow create a set of consistent assumptions. Then when you apply these assumptions to individual banks in different markets, and they are still fairly different in terms of what happens in every market, then some of them make no sense. For instance, in Spain, we have this, well, for everybody, you have this cap on net interest income. And you do this in a year where net interest income is going up 50, 60%, and you start with this is not going to be the case. And then you talk to an investor, they understand that, and this is for us, for instance, is 3 billion more. They say, well, this is not going to really reflect what's likely to happen to you. I would say, no, this is the result, but somehow choosing this sort of fixed set of assumptions and static balance, you need to do something, and it has pros and it has cons. You do the other way, it will have pros, but it will have other cons. No, so I understand it's a fine balance. For us banks, obviously, it is about a beauty contest, but sometimes a beauty contest with rules that we don't really like because they don't really apply to us. So but this is not something that we can solve. It's just the nature of the system, that Europe is diverse and that different financial institutions are diverse. And we have a floating rate balance sheet on mortgages, and French and German banks have a fixed rate one. So obviously there's a big change in rates. It's going to be a big difference in how these impact banks. It's unavoidable. It is a great use of time for our teams. It's a great use of time, very intense period also for obviously supervisors. I wonder if we can, I'm sure we can simplify that somehow, make it less time intensive. That's my sense. I'm not going to find out now how, but I think we can work on that. But we should keep having these tests. They are essentially working, and then we need to have the private exercise that is for each, which we do on the ICAP for each institution. Now let's make sure we do our own stress testing specific to our institution, obviously with the supervision of the SSM. I think that combination is a reasonable balance, to be honest.
It's the first time I've heard a bank CEO call it a great use of time. I mean, I know people appreciate it, but it's a very positive approach.
May I step in on this for a second? Because I think there's also something very relevant about, what you said about diversity, in terms of like different banks. It's also true that we have a different scale of the banking, industry within our countries. And one thing that I think has been very interesting, for instance, in Italy and other countries, has been also to look at the rules that apply to the stress test of the systemic banks and look at how you can bring some of it also to the so-called less significant institutions. We call it the local significant institutions because they do have a role in most of the countries, for the economy at local level. So that is also something that has been going on in the in the Euro system, which is very interesting, which is to look at also small banks, with the glasses of some of the activities that we put forward as supervisor for the systemic banks. And I think that is also extremely useful when we talk about how you create a more homogeneous system, also to look at the small banks. They are very relevant for the economies of our countries. And they have been kind of left aside, for many years, and some of them had some sort of social juridical construct that didn't allow, some of the speedy activities that could be done in other sort of juridical forms of banks. Some of them had a hard time because of that, to have access to the market of capitals. But I think this is also a very interesting process that we're seeing. It's sort of like a byproduct of the SSM at local level. We're definitely in Italy working a lot on this, trying to really bring a closer look at the way in which we deal with the small banks, getting a lot of examples from the activities that we put forward for the systemic banks.
Well, indeed, the more homogeneous we are when applying, all these methodologies to the local, less significant institutions, I think the more we promote, let's say, the level playing field.
Yes.
Because also we step up a bit. Of course, we raise the bar for the local institutions, but also we compare peers with peers, not peers with apples. So I think those initiatives in terms of, thematic reviews on governance, thematic reviews on business model, applying stress testing, of course, with proportionality, under the idea of proportionality, I think the better we are, in terms of a European system.
Mm-hmm. I love the idea of the byproduct, positive byproduct of the SSM. But Claudia Bull, you wanted to jump in with a point.
Well, just quickly again to say why I think we need the stress test so crucially, because this is really the most important forward-looking part of what we're doing. So the risk weights in internal models and also in the standardized approach, but particularly in the internal models, they don't really give us this forward-looking perspective. So they're basically calibrated on data from the past. So a lot of the regularities that we have seen in the past, I mentioned the correlation between, large GDP shock and corporate insolvencies during the pandemic was a very unusual pattern. So it's very unlikely that we're going to see those correlations in the future. So we need this. We need kind of the forward-looking element. And I fully agree that this just the one macro scenario is not going to fit for all the banks. This is very clear. This is why Jose Manuel said we also look at more, sectoral breakdowns. I think in the European stress test, we have quite a strong bottom-up element. So the point that you made about the macro scenario doesn't fit for all of us, I think that's to some extent alleviated because we have the strong bottom-up part. But of course, that's the part of the process which is very labor and time-intensive. So we could do more top-down, but then this issue would be more relevant. So this is a bit the trade-off we are facing. And then in the end, the results from the capital depletion in the stress test go into the P to G. So then everything that goes into the P to R, these are the specific things that we see with the banks. If there's issues about data quality, process, governance, all these things, and I think they are independent from the specific macro assumptions that may not fit for the individual bank. But clearly, I think we need to go more into the direction. That's what I said earlier, of taking different scenarios into account, scenarios that are more fit for purpose for the individual bank, and also give guidance there. I think that's kind of the challenge for the future.
Okay, super. Alessandra Pericelli, you raised the issue of non-bank financial intermediation also in a speech in October, but also in the outset of our panel today. I'd be fascinated to hear from you as we look forward to the next phase of the SSM, how you think these institutions should be, if not supervised, how they should be handled also from the perspective of a banking supervisor. And as catchy as NBFI is, I would love it if you could specify which kinds of firms you have in mind. If you're thinking more about private credit, or if you're thinking about payment firms. It'd be great if you could drill down a little bit, think how can you as a supervisor get to grips with them in the coming years?
Well, this is something that we've been discussing, also with my colleagues here, and we definitely are right now in a situation where we see a very different financial landscape, on the global sort of level, but also in Europe, and there is a rise of non-bank financial intermediaries, and a lot of more interconnection between financial intermediaries, payment systems, the rise of asset management firms, investment firms, and investment funds, and all of these become very much interconnected with the banks as we know them, as we have been dealing with. And I think this is a positive development. I think this is very good. I think it can, push economic growth, but it also introduces, a different level of risks, because of course there can be, potentially lots of spillover effects, and I think that we cannot sort of disregard all this from a supervisory point of view. The other significant challenge that we have is that most of these non-traditional financial sort of intermediaries, they fall outside the scope of prudential supervision. I mean, they're not there. And that's a bit of a blind spot for us. So the point is, you know, whether, you know, we want to follow the risk, kind of challenge, you know, risks as we see them, whether these are new risks, can they be brought into, you know, so far we've been looking at operational risk, you know, we look at, you know, some of this new issue coming in with also MiCAR and DORA, we have everything that is connected to security, you know, with cyber risks. So the point that, you know, I'm trying to kind of bring on the table also and discuss with my colleagues is whether we are facing something new, a new kind of risk that we need to tackle, and what are the instruments that we can put on the table now that we have grown a strong house, you know, and we do own some of the, you know, the tools, we own them. You know, we are able, look at us today here, we're able to really talk about it, and that we feel that those have been extremely interesting and progressive in the way in which think 10 years ago, where the industry was at European level. Look how far, you know, we came. So I think that we are now really on the edge of a new phase, and is brought by, you know, the application of technology to the financial system. We also have the rise of fintech companies. They are, you know, getting together with banks. We look at the way in which banks they try to become, you know, sort of more digital. You know, we look at the models of banks creating new financial sort of digital small banks, and they try to migrate clients onto those platforms. We see other banks that they're trying to do it from within, which is a lot more difficult because, of course, this legacy that comes, you know, with IT development it's really something important, something difficult to deal with. So I think that we need to address, we need to recognize, you know, these interconnections, and we need to really identify the related risks. And this is, you know, I think it's a new phase for the SSM, and I think it's a very interesting phase. I think that, you know, we have some of the, you know, some of the national authorities have put more effort on developing, you know, IT departments and an approach, you know, to technology, which is already embedded into the way in which we'll look at the market. We've been working very closely with Banco de España on this initial phase of creating subtech instruments. I think this has been a very, very important phase for us of coming together. We have different strengths, you know, in the different NCAs. You know, Banco de España has been there with data for a long time, and we all recognize that. We're being, you know, a lot more onto the development of experimentation. We're now experimenting a lot on AI and generative AI. We have been working together with, you know, the Banque de France and with the Dutch bank on a number of instruments that today are, you know, at the disposal of all the members of the SSM. But I think that as we move forward, I think that we need to kind of look at this as a real change of skin of the financial industry in Europe. We also have another issue, which I think is very important. I mean, we're very good at creating rules, you know, but I think we also need to look at technology, developing technology in our, you know, in the Euro system. So I think that we have a great role in trying and do this and foster innovation at the same time, you know, keeping that stability factor in, just making sure that, you know, what happens doesn't have spillovers on the financial stability of the Euro system. So I think that we are in a good space as Europe, you know, and in particular, I'd like to mention that in Banca d'Italia we created this, you know, innovation hub. We're working on call for proposals, and we're asking the market to come up with solutions that are then we coach, you know, for at least six months. We do it all the way up to the, to the creation of a prototype where that, becomes subject to commercial contracts, and that, will come out of it because it can become like a supervised entity. So, but this initial phase of fostering this creation of new technology applied to financial services is very, very interesting for us because we understand how the rules need to be changed if necessary, need to be completed, and and I think it's very good what we're doing because we're bringing this sort of, we harvest this experience also at SSM level. So I think this is very much, I truly believe this is a new phase for us as supervisors, that it has to be clearly defined, and risks clearly understood, and what kind of check and balances we want to put in place there.
So a clear focus on technology there. But if I may also think about sort of other institutions so there are private credit funds, for example, which compete with banks in lending. There are also, payment companies which compete with banks in some areas too. But one key difference is that whether private credit or certain types of payment funds, they don't take deposits. And so when you and your colleagues speak about whether it's good to put in place macroprudential measures, whether they be buffers or other instruments, do you actually have the legitimacy to do this? And it's to all the panelists. I mean, to really to say, okay, yes, there are no deposits at risk here, but we think that it is in the interest of financial stability to go out and have a discussion about macroprudential policies or other risk or other closer supervision, be what it may. Please, Claudia.
No, go ahead.
And first of all, from all these developments, you asked what are the most relevant NBFI, or formerly known as shadow banking activities for the banks. And I think those that cut through the value chain of banks and that have an impact on banks' deposit franchise, I think these are the ones that are most relevant for the banks in terms of market power and losing market share. So what we've certainly seen is that globally, after the global financial crisis, we spoke about the reforms in the banking sector, banks have lost market shares to NBFI, and that's also, to some extent, it's an intended effect of the reforms that risk should migrate to those part of the market where they can be better borne. But at the same time, we're seeing that they've migrated to parts of the system where they're not well regulated. And I would say that it's not just related to deposit taking. There's a lot of evidence also for fund behavior, investment funds, that they can lead to fire sales, price spirals, liquidity dry up. So there's a lot of evidence that we can have systemic risk in that space. And the problem we have is not that we haven't understood this. So there's a lot of work in the Financial Stability Board being done in Europe, in the ESRB, about these systemic risk implications of NBFI, but we have relatively little tools. So I think we really need to say, also from the point of view of banking supervisors, we need to say, what is it that needs to be regulated in the NBFI space so that we don't have systemic risks there that could then affect the banks. And I think this is in our common interest that we have a properly regulated system there. So Europe is actually doing a little bit so that there can be also systemic macroprudential tools in the fund sector that can be used to mitigate the systemic risk, but they would not be in our hands, but in the hands of the respective institutions. One last word, bringing it back to the Capital Markets Union discussion. I don't see a case for banking union, and there is a clear case for banking union, and we would all want to have more, and not having the case for capital markets union. Or in other words, we need capital markets union also to deal with these issues. Yes. So to be able to implement, if needed, systemic risk tools, macroprudential tools in that space so that we understand the spillovers in the system. I think this is crucially important for the banking sector and also for us.
Super. Would anyone else like to expand on that point? If not, I would go to Gonzalo with a question. You mentioned the acquisition of BPI several years ago, and its successful bank with well capitalized, profitable, lots of liquidity, and several other European banks are in a similar position to you are. I mean, BNP Paribas has a unit in Belgium with lots of liquidity. UniCredit has HVB in Germany with, again, lots of liquidity and capital. But this liquidity doesn't move at all around the euro area. And maybe you could explain sort of why you and your peers are hesitant to apply for a so-called waiver, a liquidity waiver, to be able to move money from one country to another, to be able to lend it out again. And is there something which the ECB or other institutions in Europe can do to solve this problem and to make it a truly European market?
Thank you. I would say this is not a big problem, certainly not for us at this stage, no? But I understand the fundamental question. If you look at, as we have plenty of liquidity both in Spain and Portugal, so we're not really in need to move liquidity there. We have actually developed our business in the Eurozone over the last 7 years. We now have over 20 billion of lending, CIB mostly, to non-Spanish, non-European residents, and we're funding that out of Spain without any problem in the CIB business so large. And obviously, we're seeing the advantage of Eurozone and moving liquidity at that level. I think overall the liquidity situation in the system is fairly or very strong. Again, another good point of the work of the ECB over both at the monetary level and also certainly at the SSM level. And we had this acid test with Silicon Valley, that crisis, and Credit Suisse. And honestly, to me, it's the coming of age of the European banking supervision and system and saying, okay, we withstand all this. So that's why I think we need to move on to another phase. It doesn't mean we shouldn't be taking care of the problems that we have already solved, because problems tend to come back if you don't keep an eye on them. So I'm not saying let's not look at liquidity or capital, whatever, but these are problems, in my view, of the past. Problems that the Spanish or we would have, and we have, and other Europeans have in expanding outside of their regions or their home countries. Again, I'm sorry to come back, this is not an economically sound proposition. You have 16% or 15% cost of equity. It's very difficult to find good investment opportunities. All the incentives you have is to take money out of the bank, because generally you don't find returns at that level. And this is very worrying. We are now making 15% on tangible equity. We're trading above book or tangible book, so we should be okay, great, but still that's 6 times earnings, round numbers, no? And still it means a very high cost of equity. And then when we look at should we expand in Italy, France, Germany, and say, are we going to really manage to get a return on the capital we invest there that is above 15%, that is what the market is saying, it just doesn't happen. Or at least we haven't found it. It may happen. Let's be modest here. So that's why we go back to, okay, we have a problem. We have a problem with that incentivize banks not to grow, not to expand, is to withdraw capital and to increase margins, because that's the only way to get. And this is a race to the worst, because when we had return on equity of 7%, you could say, okay, legitimately, you should try to be double digit, okay? When you're at 15%, really, what you need is to bring down your cost of equity. You are not, it's fine if you make 16 rather than 15, but you should be in a reasonable region. And again, with that, are we going to expand cross-border? I just don't, all institutions like to grow and do more things, and we think we could do banking outside of Spain, of course, and we've proved that in Italy with a great bank, and we're doing CIB, and we've created Xnovo, a private bank in Luxembourg. So we're doing things we're sort of niche where we can, but we don't get there because we have this problem. And again, it is, and I agree with comments here. A large part of it has to do with sustainability of earnings and that question mark. A large part of that has to do with long-term questions. Is there really growth? Fintechs, big techs, how are you adapting to all these things that we need to deal with? But they are there. So when we take measures and decide things about the European banking system, we need to take into account that these things are there, so how can we help and solve this issue? And one way definitely not to help is putting taxes on banking, okay? So that is clearly, you look at an industry that we're saying is cyclical, okay? You have bad times, you have good times. Over the last 11 years, our average return on equity has been 4.8%. That's hardly a high number. That's from 2011 to 2022. So now we come a year where things got slightly better, or better. Return on equity, not on tangible equity, on equity, 13%, which is still, you look at the IBEX in Spain, just to average return on equity for the IBEX, 17%, okay? So we're clearly below any level of excessive profitability, both historically, because you need to somehow round the average of the past and the current, and comparatively with other sectors. And then you still have, not just Spain, Spain is obviously one, but some are going to say, we need to tax the banks, they're making too much money. This is not true. This is generating the perception for investors that say, okay, this is a cyclical business. When things go badly, we don't make money. When we make some money to try and recover past time losses or low profitability, then we get taxed away. Obviously, that again increases cost of equity for the system. I'd be surprised if people want to bank into Spain or bank from Spain outside if you have a system where somehow this threat of upside is going to be taken out of you is up there. No? So that's another issue that creates problems in consolidation and expanding banking rather than, to my knowledge, currently liquidity. It may be an issue for some banks, I obviously respect that, but generally I don't think that's the most relevant part of it.
Mm-hmm. So unless someone would like to address bank taxes, probably not. Would any of the supervisors on the panel like to share some thoughts on how, what work can be done now in terms of actually addressing this fracturing of European banking markets? I know, please.
Yeah, for me, because I think that's, I'm sympathetic to a lot of what Gonzalo's been saying. I think that, I'm not going to address taxes, by the way. No. But I do think that he just highlighted at the end a challenge that the industry has, which is from the point of view of society, the industry is making way too much money. From the point of view of financial investors, the industry doesn't make enough money. And that's a communication challenge. Coming back to transparency and who you talk to, you need to communicate that in a consistent way, in a way that everybody understands the same thing, and maybe the effort is try to explain to the society that they're not making enough money. No, I also think that there's a challenge in trying to explain that the cost of equity should not be that high, right? And that's a difficult challenge, I'm not going to say. But more deeper than that, what I do think is a real challenge for Europe is that the competitive dynamics in the industry should be there. Because at the end, the average profitability, I don't like talking about averages, but if the average profitability is low, it's because the average of the industry is not competitive. There could be good ones, there could be bad ones, but on average, that dynamic is not good. We know as well, and we have here the Single Resolution Board, that we don't liquidate enough banks in Europe. That it's not orderly restructuring. What I like is like good banks to excel, and that doesn't necessarily mean consolidating. Whatever it means, that they excel, that they grow, and bad banks that they leave. And that churning is what we don't have enough. We don't, we look at the statistics, and the average number of banks that leave the industry is lower than in the United States, which is about the same size in terms of number of banks. We do see that the number of growth of market share, quote unquote, stealing market share or increasing market share is low. We've seen over the last year and a half on the issue, for instance, a very, very tangible issue, which is what we call the deposit beta, the sensitivity of the increase in interest rates to deposits and the likelihood that depositors may be ending up being very competitive, which we thought as part of the digitalization process, that would be a dynamic that would be much likely to be more active in this new rate cycle, actually has been relatively low as well. So that dynamic of competition, we know, if I might go further, the number of banks that are subject to the market for corporate control in Europe that can be bought or sold are small. It's a small percentage. All that dynamic needs to be improved upon. That hasn't a lot to do with prudential supervision. You know, they take a lot of those stakes as given. It has a lot to do with working, deepening of the banking union, finishing the banking union for sure, but also deepening all these other rules so that those dynamics become more healthy.
Mm-hmm.
I think there's some work going forward.
Would one of the supervisory board members like to pick up on this? No? Claudia?
Yeah, I mean, what can be done now? I think my first reaction is, I mean, the work we're doing every day is contributing to integrating the market and removing frictions that don't need to be there. But I think what we need is also a better dialogue with the broader public to explain why all this is important. So this is not just for technocrats, but having a functioning, well-functioning, even better functioning banking sector, integration of markets in Europe, that's to the benefit for everybody. It's not just, you know, something for the market participants. I actually heard many, many years ago about the Capital Markets Union. I heard, well, this is only, you know, this was always a UK project, so why do we have to continue working on it? Yeah. This is many years ago, but I was giving a speech and I thought, well, I always thought this is because we want better risk sharing and all these benefits. No? So we have to explain this, and it's not easy to explain. I think it was easier after the crisis for the banking union because there was a clear case how, you know, what happens if things go wrong. And now I think with the next integration initiatives, we did not have a crisis yet, and we all hope that we don't have the next crisis coming, but there's certainly the probability of having more stress in the system, and so we need to prepare for that. So it's in our everyday work, and it's, I mean, there's a big file on the table in Brussels, which is CMDI, crisis management and deposit insurance. So this is fixing the issues that we are aware of in the current system to make the system more responsive to stress cases, to have more banks under resolution. And I think it is crucially important that we move along this front, because in the end, if we have if the situation continues as it is, and if we have stress situations where we can't deal with the failing banks in the way we should be, then this has negative implications for growth, for fiscal policy, for monetary policy. So, and that is something we need to explain. This is not just, you know, a technocratic issue, but it's really crucial for the functioning of the European market.
Yeah,
please.
I maybe just, play the devil's advocate here.
Absolutely,
maybe,
love the devil.
Maybe this is not my role, but the question is why there are no viable integrations on the table. Because if there is a business case, I'm sure that the bankers will be really eager to take over and really start a consolidation process. So the question that we should, ask us is why this is not happening. Why, either because of the lack of competition. We live in a Europe which is overbanked, for sure, not specifically my country, but on average in Europe, there are too many banks, way too many banks. Yes. Why there is no a kind of a business case, a business initiative to search for additional profit and to increase the profit? It's just because we have too many barriers. It's not a question only of liquidity. Maybe, liquidity is just a tiny thing here, because now, in the current situation, banks are really plenty, they have plenty of liquidity. But it's more a question of a business case, because this cannot be achieved just through cost reduction, because that stage, we had it in the past, but now, clearly, they should, invest more in platforms or in vertical additions and aggregations. I'm not sure. I'm not a banker. But maybe we should be questioning why there is no this appetite, because there is no profitability in potential business across Europe.
Alessandra, I see you nodding.
Yeah, I'm nodding because I very much think that this issue of business model is extremely important. Look at the way in which many banks have expanded into, payment systems because of the revenues that came from the use of, specific circuits, specific associating with a number of large, enterprises that could help specifically on small banks, lots of revenues came from that. So I think that there is an issue of business case that needs to be looked at. We need to ask ourselves, you know, like Jose Manuel was just saying, you know, whether the competition situation is changing, how it is changing, what are these new, you know, comers to business. So I think that we're going towards a more integrated business case that it's going to bring together a number of different players and a number of different technologies. And I just wanted to also touch on something that we haven't been, you know, talking about is, as we move towards, you know, an algorithm-based sort of like way of providing services, I think that we need to look also at ethic issues. We have in front of us, you know, a new world that is going to bring, you know, new forms of biases, the need to look at issues that concern inclusion, the needs to avoid polarization, you know, in the market between those who have access through a financial and digital education and those who do not have that. You know, I think that all these issues that are becoming more and more integrated with our daily work, I think that that's where we really need to, and we have the possibility of stepping up, because I think that we have great capacity also, you know, in the NCAs at a European, you know, in the ECB level. We have great capacity to tackle all these issues. But I would really pinpoint business models over, you know, over banking in Europe, digital transformation, how do we tackle also issues that, you know, they come together with transparency, but they come together with the way in which we communicate, the role of banks in also, you know, the economy of our countries. All of this, I think, are going to be really the you know, the good things that, you know, Claudia will lead us through.
Well, you bring me to my very next question for Claudia specifically. So obviously the supervisory board that you lead, not just the members here today, but sort of the whole board, really took the Wise Persons Group report from last year on ECB banking supervision very, very seriously. It's still very early days in the review of the ECB's practices in this front, but could you give us an idea of the work streams that you might have in mind, or a big picture view of sort of like of what you will be able to to deliver in the short, medium, and long term?
Yeah, no, thanks. I mean, this is a bit the forward-looking part, and actually the forward-looking part started well ahead of my time under Andrea Maria and Andrea and Ria, because I think there was the recognition in the supervisory board and the team that after, you know, the build-up phase that has been described, and the consolidation, and also the getting the consistency, then we need to look at what can we still improve in terms of the process, and where can we also improve. I think this is also in the interest of the banks, that we reduce kind of the bureaucratic burden that is there. Inevitably, if you build this up, if you want to make things consistently, then at some point you need to step back and say, what are the elements that we don't need anymore, where we can simplify. So this started early on. There was the report of the Wise Persons Group, and I think it's actually interesting to see that it came out almost exactly at the same time in March this year, so a year ago, when we had the events in the United States and in Switzerland, and I think it really reinforced the message that one key lesson is that we really need to understand this interaction between governance problems in the individual banks and the macro developments, because this is typically when crisis happens. So when, you know, in a tranquil environment things are fine, but then if a shock hits, then it's really where the fault lines are being exposed. And I think we're right on track there to understand this. And the second thing is, I think that's also very nice and clear from the reports that have been written by the authorities. There was often the supervisory findings were not followed up sufficiently fast. So the authorities knew about the problems, but then there were delays in the process, maybe for good reasons. And I think it's in the interest of all of us, of course, in terms of supervisory effectiveness, but also in the interest of the banks to know what are really the things that we find particularly important, where do we want to see remediation, where do we want to focus, and also what is happening if remediation is not happening. So of course this is maybe the unpleasant part for the banks and the supervised entities, but I think in terms of clarity, what we want to achieve, I think this is crucially important. And this is exactly what we're doing, and we've started with a lot of initiatives already. So I think we are now more risk-based. We are, I think, quite transparent about the supervisory priorities. They're being published, so I think it should be clear what our priorities are. I don't know whether we have enough time to talk about the whole climate initiative, but in any case, that's an area where we've been very clear about our expectations and also how we would escalate and use all our instruments. So this is happening already. So more risk-based, more focused, and making clear what is really at our focus. We're also using this multi-year framework that not every risk has to be looked at with the same intensity in the same year. I think this also makes a lot of sense because there's a lot of structural issues. We've also changed the SREP letter in the sense that now there's an executive summary making more clear what really the priorities are, because the SREP letters can be long because of course they need to explain the evidence. And as I said, we're moving with regard to supervisory effectiveness. So these are things we are doing already. We can still of course improve on how exactly we implement them, but this is there already. The two main work streams going forward. One is on P2R methodology, so we're currently just discussing this with the aim of also making it more transparent and clearer in the application. The aim is also, once we make changes to the methodology, then to keep it stable for a sufficiently long period of time so that we don't make, I mean, there might be always small improvements that we can make, but basically decide on a methodology, keep it stable, and then revisit it after a fixed period of time, because, you know, things might have changed. And the second big part is this: how can we make the overall process, the SREP process, less bureaucratic, more focused on what is really relevant from a supervisory perspective, again in the spirit of also giving clarity to basically all of you and also to the industry, what we expect and where we expect the remediation. But these are the two parts, I would say, the big two parts, which are still under discussion. So my colleagues here, we will discuss them together, and I think we are, I mean, I must say, of course, there's always details we can discuss, but the overall spirit around the table, the supervisory board table, is very clear that we want to make progress here. We also want to give clarity as soon as we can, as we've finished our own internal discussions to the industry. So there's big consensus around the table, and I hope my colleagues don't contradict me now.
No, not at all.
No, because this is really very, very clear.
Yes.
Okay. Would either of you like to expand upon that? I mean, Claudia, at the beginning, she also spoke about how that SREP would never be sort of an AI-driven event, which sort of you put all the data in and then sort of out pops the P2R at the end. But are there any things which you would also like to share about sort of how you think the path forward should be? Margarita?
Well, maybe of course, we need to really bear in mind that supervisory process is under a constant review and improvement, because we all want to achieve, as Claudia very clearly mentioned, to achieve a more effective and efficient supervision. I think the SSM has been very successful so far in implementing the strategies to risk reduction and capital strengthening. Although it is true that this is not a given, for sure, but I think this is a very good basis for the future, for sure. So I think we've weathered the storms together. I mean, the recent storms, the COVID-19, of course, the energy prices, the Ukraine war, increased inflation and interest rates hike, together with, I mean, the different institutions and authorities, including, of course, I mean, the governments and the fiscal support. But I think we will need to keep enhancing the capacity of the supervisors, and this cannot be done without the right prioritization, of course, to become more effective, as Claudia mentioned. I think we need to keep defining methodologies to better capture the new risks, for sure, with all the difficulties, and also stay and remain flexible with the capacity to react just in case a crisis comes, as we did during COVID-19. So I think all of us here reacted very well. Also the banks and the bankers reacted very well. I think they were part of the solution instead of the problem. So I think we need a more effective supervision, a more efficient supervision, and also a more prioritized supervision using all the tools that we have at hand, such as the ones that Alessandra mentioned. The SubTech initiatives are really crucial for the future. So I think that the future is in our hands now, in the hands of Claudia under her leadership, but I'm sure that we will overcome all these challenges, and we will improve our supervisory evaluation process, very soon.
Okay, well, with those words from our hostess and then the host at the Bank of Spain, I would end it here. I could go for 2 more hours. I don't know about you, but don't worry. I hear there's good Spanish coffee to be drunk afterwards as well. So, but please join me in thanking this wonderful panel. Thank you very much for your time today.
Thank you.
Thank you.